Welcome to Subramani. One thing which you have been hearing is why are the markets going down? Because interest rates are going up, right? So you have been told that when interest rates go up, markets go down. This is not totally correct. The way you have to look at it is when interest rates go up, asset prices go down, right? So what happens is, if suppose the interest rates prevailing in the country, which is the GSEC rate, the rate at which the government borrows, is say, I want to take very round figures, so say 6%. So fairly obvious that when you give money to the government of India, you are getting 6%. So any bank will have to offer you at least 6.15 for the same tenor. So if the government is borrowing at 6% for 10 years, State Bank of India or HDFC Bank or ICICI Bank will have to offer you more than 6% for 10 years, right? So the short run it could be 5, it could be 4, it could be 3, whatever. But for the same tenor and the borrower being other than the government, it will have to be a rate higher than the GSEC rate, that is called the risk premium. So if there is a bank which is offering you 10%, it means they are offering you 4% more than what the GSEC is offering, that is the government securities is offering. Now what happens is, if you can get 6% with the GSEC and if you can get 6.5% with HDFC Bank, you can get 6.6 with ICICI Bank, or all in the same range, then obviously when you have to take little more risk, if some XYZ NBFC comes out with a bond, you will ask for a higher risk premium. So let's say you ask for 9%, which is fair enough, and some company comes and gives you 10, somebody comes and gives you 11, whatever. So they are all giving you a risk premium. Now funnily, equity also deserves a risk premium because you are taking the risk of variability. Of course, we all believe that equity in the long run will go up. So technically there should be no risk premium, but there will obviously be some risk premium to the bond. So that bond may be at to equity, sorry. Bonds would be at 10%, let's say, and your bonds being issued by NBFCs, etc., could be at a higher rate than manufacturing companies, and equity will have to give you 12, 13%, 15%, something like that. There will have to be a higher premium. Now when I am talking these numbers, don't talk in absolute, I am talking in absolute terms just to show you that there will be a difference. In real life the difference may be very less, right? So 7% is the gilt rate, your equity may give you 9% or 10%, that's about all. But I am just showing you this for dramatic impact, because when interest rate changes, I will want to tell you what happens. So similarly, when you buy gold, you think gold should give you at least 7-8% because 6% is what you are getting in gilt. When you give a house on rent, you will get, let's say in Bombay, you get about 2% off as rent yield. I am not talking about society charges, etc. If you take that off, it is even lesser. So which means that a property will have to appreciate at least by 8-9% a year, so that total compensation that you get is 2% plus 8-9%, about 10-11%, because you are taking a huge risk in buying real estate. Also, real estate has to give you a return greater than the rate at which you are borrowing. So if your home loan rate is 7.5%, the appreciation in the real estate has to be at least 9%, 10%, because you also have to get a risk premium on the rate at which you are borrowing. So this is the expectation, right? So at 6%, when the GSEC is there, you want all other assets to give you 9, 10, 11, 12, maybe 15, right? That's what your expectation is. When your expectation is that much, let's say there is an equity share which is quoting at 100 rupees, you are buying at 100 rupees, you are hoping that along with the dividend and the appreciation, end of the year you will be able to sell it at 115. That is interest expectation, right? Interest expectation is 15%, so it should at least go to 115. Now let's say the interest rates are increased from 6% to 9%, right? GSEC becomes 9%. Then what happens is your expectation from everything else goes up. Why should you, what should you get in a bank FD today from HDFC or SBI is definitely more than 9%. Maybe you should get 10.5% interest, bank interest. So to get 10.5% bank interest, you will break your old fixed deposit, assuming there is no penalty, which was at 6.5% and or 7%, and you will come to a new fixed deposit, right? So that is what you will do with the bank. because you can do that. What will you do with bonds? You will sell the old bonds. Understand what you're doing. You will sell the old bonds because it is giving you lesser yield. So when more people sell, prices fall, right? And new bonds will start getting issued at say 10-11% because you want a risk premium. So 9 is what GSEC is paying you. Now similarly, what will be your expectation from equity? In equity also your expectation will be, well, if I buy this share at 100 rupees, will it go up by at least 20%, right? Because now my expectation is I want a greater premium. Maybe will it go up by go up more. If the answer is I'm not sure whether it will go up, I will sell equity, right? I will sell that share at 100 rupees and say I don't think it will become 120 by the end of the year along with dividend. That is my expectation. Since my expectation has gone up, I will sell shares which are higher priced because I think it can now not appreciate. The EPS growth may not happen, the PE growth may not happen. So I will sell the shares. Now from all this, one thing which you should have understood is when interest rates go down, asset prices go up. When interest rates go up, asset prices go down. Now please remember, all this is only in the short run. So immediate reaction, let's say 6% to 9% jump happens in one day, then all other asset classes other than bank deposits, the first to react is bank deposit and bonds, because there you know exactly how much interest you're going to get and the date of maturity. So it is easy to price and say, oh, this goes up by 1%, that should go up by 2% or whatever. You can find that, so that much the price will fall. And the correlation is negative and the price will fall. That sensitivity will happen. Now first asset to react will obviously be bonds because of the clarity. Next will be your gold will also definitely fall in price when interest rates go up. People will say gold will not give me 10% appreciation, I'm already getting 10% in the bank, so let me sell gold, right? This is a perfect market scenario. Normally retail people don't sell gold, but I'm saying the perfect market scenario. Similarly in real estate also, people will say, oh, 2% yield is too less because the flat may not appreciate, so let me not buy at this price. So again, either you will sell your assets or you will say let me not buy fresh assets. So again, prices are pressurized. So real estate will also react, and the last to react will be equity, because in equity again the dividend yield is very low and the hope is greater in appreciation. So you will say no, but when people expect people are getting 10% in bank deposits, here people will expect more, so people will not be willing to pay a high price. So you will also not buy equity at a high price. So there will be selling pressure on equity and there will be no buying at a particular price. People will say 100 is not the price which I wish to pay for this, I wish to pay only 90, right? So when interest rates change, asset prices change, right? And the relationship is negative, which means when interest rates go up, asset prices will fall. When interest rates fall, asset prices will go up. This will happen, and all this will happen only in the short run. In the long run, people will have to be compensated more. If I can already get 10% in a bank deposit, I would expect 12-13% in an equity share or 14% in an equity share. So when the company comes out with an IPO or an NFO or or a follow-up offer, right? I'm not talking of an NFO, sorry. Whenever the company comes with a rights issue or something, they will have to compensate me at a rate higher than the prevailing interest rate. So if interest rates prevailing is high, I will have to price my share low so that people will be tempted to buy it. So that is what happens in the longer run. So in the longer run, you will start getting assets at higher prices because the compensation will have to be at least for the inflation plus risk premium. So prices will go up. So when interest rates go up, asset prices will go down. Assets include bonds, bank deposits, your gold, your real estate and equity. Equity will be almost the last because you do not know how much you're going to get by dividend and you do not know how much is going to be the appreciation. But this is the impact of interest rates on assets, all assets, whatever be the assets. Expectations change, so people will not be willing to pay a high price. That's what it is. Thank you.